Hello and welcome to another episode of Insurance in Canada. I'm your host, Rick Pedeta. Thank you so much for joining me. On today's episode, we look at three stories. The first story, dealerships in Quebec have been ordered to stop selling a type of replacement insurance. The second story, we go to Ontario and look at the upcoming changes to accident benefits and how some people in Ontario could be left without coverage. And our last story, we go into the wide world of maritime insurance and how the United States has offered to take up coverage where other maritime insurers have started to pull coverage because of the action in Iran. So without further ado, let's take a look at insurance in the news. Our first story comes from Quebec, where auto dealerships in Quebec, have been able to sell a type of replacement insurance. But recent changes to legislation in Quebec is changing the ability. They will be prohibited from doing so. So let's take a look more into this story. Quebec gives auto dealers more time replacement insurance changes. More time for replacement insurance changes. Quebec has deferred the coming into force of a legislative amendment that will prohibit automobile and recreational vehicle dealers from offering replacement insurance, originally scheduled for July 1st, 2026. The prohibition will now take effect January 1st, 2027. That means effective January 1st, 2027. Distributors, including auto and recreational vehicle dealers, will no longer be able to will no longer be permitted to offer replacement insurance related to the vehicles they sell or lease. This product must be obtained through licensed firms and representatives in Quebec, such as agents or property and casualty insurance brokers, law firm Denton says in a bulletin Monday. Other insurance products lawfully offered by dealers are not affected by this change. Replacement insurance, known as QPF number 5, Quebec Policy Form number 5, is a replacement cost policy in which an insurer pays compensation to replace a vehicle at the dealership the insured has chosen, explains the Chambre de l'assurance de dommage. Quebec's regulatory body for damaged insurance professionals. Replacement is mandatory. QPF number 5 is different from QEF, Quebec Endorsement Form number 43, a replacement cost endorsement that allows an insurer to choose to either replace a vehicle or receive compensation. According to a November 2022, 2022, comparison document between QPF 5 and QEF number 43. Both auto insurance products protect against depreciation when the insured makes a claim in the wake of a total loss or partial loss. For new vehicles only, QPF number 5 does the following, among others. So before I go any further, so QPF number 5 is a unique policy form in Quebec. I know of no other province or territory in Canada that offers a similar policy form. QEF number 43 is a very common endorsement you do find in other provinces and territories. Ontario has OPCF, Ontario Policy Change Form number 43, but Ontario does not have a similar type of policy form to QPF number 5. And like I said, other provinces also have a similar endorsement form that's also number 43 as well. They call it different things, but it's meant to do the exact same thing. So that's a very unique thing with that they have in Quebec. But getting back to the what QPF does, allows the insured to choose a term between 1 and 8 years at a fixed premium for the length of the contract. The term can cover the financing period, so that's a very unique thing to the QPF as opposed to the QEF or the Ontario version or other. I can tell you right now, the Ontario version of the OPCF 43, no insurer offers to go all the way to 8 years. Most insurers Some insurers stop at 36 months, so 3 years. Some insurers go to 48 months or 4 years. Some insurers go all the way up to 60 months or 5 years. So if the vehicle is involved in a total loss within that time period, the insurance company more than likely will pay you the amount that you paid for the vehicle. So they do not take depreciation into account. But like I said, no insurer goes that far outside of Quebec to like 6, 7, or 8 years, and B, a fixed premium for the length of the contract. No. With insurance companies, I can tell you right now, an insurance companies in Ontario and all the other insurance companies in the provinces that have private insurance schemes, so all the other provinces except BC, Manitoba, and Saskatchewan, the cost of the endorsement increases for every year that it's on the policy itself. So it's one price during the first year, second year two, it costs more. How much more is going to vary from insurance company to insurance company, all the way to the third, fourth, or fifth year, increase in the premium steadily. Uh, so that's another unique feature when it comes to the QPF number 5. Second point, ends after a claim is made, a total loss. A QPF number 5 insurer will reimburse the unused portion of the premium according to a cancellation table. A new contract is required for the new vehicle. Premium is calculated based on the vehicle's value and the length of the contract without regard to the insured's driving record. Payment may be included in the vehicle's financing contract for 1 to 8 years. Interest charges apply and could increase the cost. Regardless of the circumstances of the loss, a QPF number 5 insurer reimburses the insured for the deductible up to the amount stipulated in the contract. That's another unique feature. The OBCF 43, the deductible would still apply if it does apply for that particular claim scenario. So the QPF, like I said, it's a unique policy form that I'd never heard outside of Quebec. Uh, doesn't really is I mean, the term length is superior to the number 43 version. However, we are selling an insurance product by non-insurance professionals, so that's probably the biggest issue with this particular policy form and who's selling it. Back to the article, car and recreational vehicle dealers as well as the insurance sector are facing a major legislative changes introduced by Bill 30, enacted as Act 15, an act to amend various provisions mainly with respect to the financial sector. A key measure of the reform is the prohibition for distributors to offer replacement insurance related to the vehicles they sell or lease, and that's probably a conflict of interest issue as well. On February 26th, the National Assembly of Quebec adopted Bill 11, an act to amend various provisions, mainly for the purpose of reducing the regulatory and administrative burden. Among its measures, the bill amends the coming into force of Section 110 of Act 15 to exclude replacement insurance from the products that distributors may offer. The entry into force of the legislative amendment in Section 110 of Act 15, originally scheduled for July 1st, 2026, has now been officially postponed to January 1st, 2027. This postponement provides insurers and other industry stakeholders with additional time to adjust their business models. Under the new deadline, current sales practices remain authorized under the Act respecting the distribution of financial products and services. So, as I said before, I imagine the biggest issue with dealerships selling QPF number 5 is we have non-insurance professionals who are trying to sell an insurance product, which for any other insurance product is a big no-no, with probably the exception of travel insurance, because many travel agents still sell travel insurance. But this kind of policy form, uh, especially being an auto policy form, that really is something that should be in the hands of an insurance professional to be selling a uh, to a member of the general public. So apparently, that's the way that the legislature in Quebec sees it as well. So an interesting policy form being offered by Quebec. Their whole automobile insurance scheme there is a rather unique uh, example. You don't see any other province, territory, or even U.S. state use the auto insurance scheme that Quebec has. So I guess this is just another evidence of the QPF number 5 is just another evidence of that. Our second story. So there are accident benefits changes coming up for Ontario uh, on July 1st, 2026. One of the changes that is coming up is the definition of who is an insured under a person's automobile policy, as well as which coverages are mandatory and which are optional. So currently, uh, many of the accident benefits are mandatory, at least for a basic amount. Starting July 1st, 2026, the only coverage that's going to be mandatory is medical rehabilitation and attendant care. All the other accident benefits, income replacement, caregiver benefit, dependent care, home housekeeping maintenance expenses, educational expenses, damage to clothing, uh, prosthetics, eyeglasses, those will all be optional coverages. Your policy, if it currently has it, will renew with those coverages. However, excuse me, for any new policy, they will be optional. They are important, so I urge you to really consider taking these coverages, but they are optional. So, who can qualify for these coverages once they become an optional coverage after July 1st, 2026 is the main crux of what this article is trying to address. So let's take a look. Optionality could leave passengers, even children, without auto coverage. Optional accident benefits will no longer be applicable for people such as pedestrians, cyclists, and certain passengers. With just months until Ontario auto insurance optionality comes into effect, industry sources continue to raise concerns for the impact on consumers, including passengers and pedestrians. On July 1st, 2026, most accident benefits, except for medical rehabilitation and attendant care, will become optional. This means consumers will need to opt in to coverages like income replacement, non-earner benefits, caregiver benefits, and death and funeral benefits, which is true. But like I said, if your current policy has these coverages, and they do, at least for the basic limits, they will renew at least with the basic limits when your policy next renews after July 1st, 2026. Optional accident benefits will no longer be applicable for people such as pedestrians, cyclists, and certain passengers, but only for the named insured spouse, dependents, and persons specifically specified in the policy as drivers of the automobile. Harry Binks, Senior Account Executive Jones Laurier, writes in a LinkedIn post, these changes will affect uninsured passengers and children, Binks writes, which is true. So currently, as the automobile policy is written, who is defined as an insured under your Ontario auto policy? It's the named insured, the spouse of the named insured, dependents of the named insured, and anyone listed as a driver. Anybody in the province of Ontario who's involved in an accident with your vehicle, either as a passenger or a pedestrian who your vehicle strikes. Uh, Also, it's possible people outside the province of Ontario could qualify as a named insured, but that's only in very specific circumstances. But we'll just focus on the uh, anybody in the province of Ontario is involved in an accident with your vehicle. That includes all the coverages currently on your policy they would have access to. But starting July 1st, 2026, only the named insured spouse, dependents of the named insured spouse, and drivers on the policy will have access to the optional accident benefits, which is all the other accident benefits except medical rehabilitation and attendant care. So while the insured would have access to, say, income replacement benefit, if they strike a pedestrian, that pedestrian would not have access to the income replacement benefit. They would have access to the medical rehabilitation and attendant care, but that's all they'd have access to. Back to the article, children injured as passengers, i.e. on a school bus, typically rely on the insurance policy of a parent or guardian. If a parent has opted out of optional benefits to save on premiums, those benefits, such as caregiver expense, will not be available. And that's very true, but then again, uh, if a parent or guardian opts out of a coverage right now, the children wouldn't have access to it, even though they're defined insured. So it's more of a parent. I know automobile insurance in Ontario is very expensive, but uh, you got to look at the long-term consequences of opting out of, especially when it comes to accident benefits coverage. So it's not just you that you have to consider and what you're paying, but all your loved ones who would qualify, who would not be able to access it because you chose not to purchase that coverage. The consequences of this is that for the parents of children injured in a school bus crash who do not own their own vehicle, they will have no option but to sue. Passengers who do not have their own auto insurance policy, such as a household without a car, may also have no access to extra support beyond basic medical coverage, putting them at higher risk. Binks add. Industry veteran and licensed Ontario broker John Bezana comments that the implications for children and households without auto policies are exactly the kind of downstream consequences these reforms raise. If they shift more families into a position where litigation becomes the only path to recovery, that creates serious public policy concerns. And that is true, but keep in mind, in the province of Ontario, if you want to sue for your injuries that you suffered in an automobile accident, unless you're suing for your loss of income, if you're trying to sue for medical expenses or for pain and suffering, you do have to meet a threshold. Your injury has to meet a certain threshold in order to sue. If it doesn't meet that threshold, you will not be allowed to sue for in a court of law in Ontario. So that's another issue is there's no accident benefits other than potentially medical rehabilitation attendant care that people without a current auto policy would be able to access. And B, if their injury isn't severe enough, they may not be able to sue in a court either. So that's another unintended consequence that whoever came up with this piece of legislation to enact these changes didn't think about either. So, but back to the article, Binks says he is horrified by the reforms. I'm still shaking my head that these reforms are not properly thought through. He writes, many children can ill afford to be without accident benefits coverage and may end up with no protection at all. That's assuming that the parents don't have any sort of extended health care benefits through their work or through their employment, or even possibly, I know there's not too many people who have their own private extended healthcare plans, but those are available as well. In his own LinkedIn post, Bezana says, with these reforms, the Ontario government is making an already complicated product even harder for the consumers to understand. When critical protections become optional, the system shifts risk onto consumers, many of whom may not realize what they are giving up until it's too late. When it comes to these new reforms, I have no doubt the figures presented show the potential savings to auto consumers. Bezana writes, unrealistic that everyone would opt out of coverage, sure, but that is a minor detail in a political presentation. I know the Ontario government keeps trying to reiterate that the intention of these changes is to give consumers choice. However, as the insurance broker here in Ontario, I can guarantee you, I can tell you with 100% certainty, I have never heard of one of my clients come to me and complain that there's not enough choice under auto policy. It is always the cost, the cost, the cost, the cost. Unless there's a claims complaint, that's about number two for reasons they complain about their auto policy. But beyond that, it's the cost, the cost, the cost. And I can't imagine that people are rushing towards the Queen's Park here in Ontario to make complaints about not having enough choice on an auto policy. I'm quite sure the government was inundated with complaints about the cost of automobile insurance. So for me anyways, I can't back up any of this. This is just my opinion. I believe the main point of these changes is to try and reduce the cost of automobile insurance, but I don't see any potential savings in the long run occurring because of these changes. Both Bizana and Binks completed a training course delivered as part of a collaboration between the IBAO. Yep. Bizana recommends the brokers take this course, and yeah, for sure, if you're a broker listening to me, or an insurance agent, or anyone involved in the property and casualty insurance business, definitely take the course that's being offered. It's a free course by the Insurance Brokers Association of Ontario, and learn more about what these changes are that's upcoming and how they can affect the auto policy. So there's a lot of scenarios people are coming up with when it comes to these changes to accident benefits and how it can leave people in the lurch. This is one such scenario. Will we actually see this? Who knows? Only time will tell. And will we see in sufficient numbers that the Ontario government would reconsider these changes and put the optional coverages back to mandatory? Who knows? But keep in mind also, it's currently a progressive conservative government that's in power now. In the future, we could see the Liberals or the NDP take the reins again, and who knows what's going to happen to automobile insurance if they were to get back in and implement their ideology into automobile insurance. Our last article, maritime insurance and the current situation in Iran and how that is affecting um, maritime insurers' uh, desire to provide coverage for those ships that are entering the Persian Gulf through the Straits of Hormuz. So let's see what the has developed with this. Trump says the U.S. will escort insure oil tankers amid the Iran war. And yes, this is insurance in Canada, but this sort of thing is impacts oil prices globally. So the ability for shipping to be able to continue through the Straits of Hormuz is not just a U.S. thing or Iran thing. It is a worldwide thing, and this can affect how much Canadians pay at the pumps. So President Donald Trump says the U.S. will provide insurance guarantees and naval escorts to ensure safe passage for oil tankers and other vessels through the Straits of Hormuz. And if you're not familiar, the Straits of Hormuz is the strait in between Iran and the United Arab Emirates that separates the Persian Gulf in the east with the Gulf of Oman in the west. Intended to head off a potential energy crisis caused by the war with Iran, Trump said Tuesday that the U.S. International Development Finance Corporation would offer insurance at a very reasonable price to help ensure the flow of energy and other commercial trade in the Gulf. In addition, he said, if necessary, the United States Navy will begin escorting tankers through the Straits of Hormuz as soon as possible. No matter what, the United States will ensure the free flow of energy to the world, the president posted on social media. Oil prices paired Oil prices paired gains briefly on the news, with global benchmark Brent trading near $80 a barrel after settlement. While the latest measures knocked out some of the risk premiums in energy markets, traders remain skeptical that it will allow oil flows to return to normal levels through the critical passageway quickly. Prices have surged more than 10% since the U.S. and Israel began attacks in Iran over the weekend, triggering widespread disruptions in the Middle East and effectively bringing oil flows through the critical Straits of Hormuz, through which a fifth of the world's energy supplies transit to a halt. Trump's post did not elaborate on the insurance mechanism to be offered by the DFC, an institution that generally exists to mobilize private capital to developing nations and lower risk for investments in poor countries. And yeah, that's the Straits of Hormuz here, Persian Gulf, Gulf of Man here. The announcement may help to reassure traders, but escorting insuring will take some time to implement. The U.S. military will first want to suppress Iran's ability to mine and attack ships with anti-ship cruise missiles and drones. A few things remain unclear about Trump's vision of offering insurance to shippers willing to move through the Straits of Hormuz. For starters, it's not immediately obvious how many will buy this insurance or what premium the DFC is going to offer. Well, considering Lloyd's, the largest insurer for shipping, has announced that they will not be offering war coverage to any vessel entering the Straits of Hormuz, I would imagine all those ship owners that own those ships, they still need to carry on business. So I would imagine they will be the ones to be interested in buying that insurance. How much insurance premium is charged may indicate the level of risk the DFC sees. A professor at Penn State University and founder of Global Policy Advisors, a sovereign wealth fund advisory firm, especially comparing that premium to what the private markets would provide. At this point, the private markets are unwilling to provide, so this could be a gargantuan undertaking on a scale the DFC hasn't handled before. The closest that the agency has come to offering coverage was providing political risk insurance to Ukraine after the Russian invasion began, according to a person familiar with the matter. But that was to insure new projects, not existing assets. To be sure, a large subscription to the DFC's insurance product could be a positive indicator that the war is under control. If a lot of companies buy it, that would indicate they have full trust that the U.S. government could meet its obligations should they need the cash to cash in the insurance. It could mean they generally see it as a likely signal that risk will be diminishing as the days go on. Trump's announcement came after some concerns were raised about insurers putting upward pressure on oil prices as insurance contracts were getting pulled, according to people familiar with the matter. Some of the world's largest maritime insurance mutuals withdrew war risk insurance cover for ships entering the Persian Gulf as the industry scrambles to work out how to price the cost of covering vessels sailing into the waterway. The administration is also seeking to address high prices for consumers as gasoline prices have already jumped to the highest level in 5 months, posing a political risk for Trump before the November midterm elections. Political risk insurance like that offered by the DFC helps cover losses due to war, violence, and other political turmoil. So, as you can see, this particular article does look at, because Canada, unfortunately, even though we're an energy rich nation, we do a very terrible job with getting our oil products from Alberta to the other provinces. Lots of interference by neighboring provinces to Alberta. I mean, technically, we shouldn't be importing any sort of petroleum oil products whatsoever from other countries, but because of the inability for the federal government and provincial governments to get their acts in order and sort this out, East Coast, the Eastern Canada imports most of their oil uh, from abroad. I just recently read an article how Eastern Canada has purchased a large amount of liquid natural gas from Australia. So a ship has gone all the way from Australia to Eastern Canada, even though that's something that can be gotten from Alberta. And even British Columbia, who's blocking the ability for Alberta to move their oil across their borders, they purchase oil from Cherry Point in Washington State. So, unfortunately, what's going on in the Middle East, what's going on in Iran will affect energy prices, gas prices here in Canada until we really learn to become self-sufficient when it comes to our own energy needs. And unfortunately, at this point, there's no real leadership in the federal government or provincial governments to try and lead Canada into energy self-sufficiency. Hopefully, maybe one day in the future, but unfortunately not now. So, bravo on the United States to try and allay fears for shipping to continue into the Persian Gulf to help stifle energy costs, oil costs, because an incident like what's going on in Iran can cause energy prices and oil prices to skyrocket. So I have to give credit where credit is due. So hopefully we'll see that kind of leadership here in Canada sometime in the near future. And that is it for me for today. Thank you so much for joining me. If you like what I do here, please like and subscribe for more. Please share this video with others who you think might be interested in the information presented today. Make sure to follow Insurance in Canada on Twitter/X. And until next time, bye-bye.